Thank you very much for joining us. As a person watching emerging markets and India, are you worried at all about the performance of the central government of the Narendra Modi party in this state of Bihar? Is that something on your radar?
Well, it very much is, in the sense that we've been hoping to see a gradual and long-term accumulation of political capital by the BJP coalition. It's important, I think, that over the longer term, Prime Minister Modi continued to make the case with the Indian people for pro-growth policies, for gradual stripping down of the welfare state, and finding ways to liberalize the Indian economy in ways that revitalize and re-energize entrepreneurial risk-taking and private sector investment. In that sense, even an individual state-level setback is something that we take seriously. But I also wouldn't want to go so far as to interpret this as evidence that that public support for liberalization, reform, and pro-growth policy has peaked and is going to swing in the other direction.
Okay, that's an interesting point. Michael, hi, good morning. What about the global markets itself? Yesterday an expert was making the point that all those global investors who sold in May and went away have returned now in the month of October. Is that the sense you're getting as well, that global equities are back in a risk-on mode?
I think there is a seasonality component to the better tone in markets recently. As remarkable as it is nonetheless the case that almost all gains in global equities over the past decade have occurred between the months of November and April. So there's a strong seasonality component. I do believe, however, that certain critical fundamental developments have also been underpinning the equity asset class more recently. Most importantly, I think, for Asian emerging markets, and something that's very important for India in particular, is the pushing out of expectations about when the Fed would begin to raise interest rates as a result of the weaker labor data that came out on Friday last week, the so-called non-farm payroll release out of the U.S.
Mm-hmm. Okay, Michael, actually more on that. Are you getting a sense that this liquidity rally, apparently, that started after the weak non-farm payroll numbers has more legs, given that it's also coming at the seasonally positive time for global equities? Are we going to see more gains for developed market and generally risk assets?
I do think that there's room for a further, what we might describe here as a relief rally in risk assets generally. And the reason I say that is because if we look at the Fed fund futures markets, they're still pricing today about a 38 or even 40% possibility that the Fed will still be lifting rates in December. And as a result, if things progress between now and the end of the year in such a way that the Fed does choose to put off interest rate liftoff until early 2016, clearly that 38% probability will have to continue dropping down in the direction of zero. And as near-term interest rate hike expectations fall by the wayside, then that should provide additional comfort level, additional relief for markets in Asia that are particularly sensitive either to interest rates as a result of the sectoral makeup of their local markets, or sensitive to currency risk and currency volatility. India, certainly by virtue of its current account deficit, falls into the category of those markets that tend to be a bit more sensitive to Fed interest rates, and therefore India should be in a position to continue to get some short-term relief.
Okay, so finally, what are your top preferred markets from now, say, for the next 6 months, and what kind of an upside do you see?
We are, in fact, still quite positive on India. India is, in fact, my largest overweight recommendation within the Asia-Pac ex-Japan region. And our local strategists are looking for a Sensex target now of 33,500. My second most favorite market in the region is Taiwan, where I see a very positive combination of both leverage to the ongoing recovery in the United States and in Europe, as well as a large current account surplus, which should give it more resilience in the oncoming Fed liftoff that we do still expect to come in March of next year. Between the two of them, India much more a beneficiary of lower commodity prices that happen as China slows down, and Taiwan a beneficiary of the pickup in developed market growth, gives investors, we think, a fairly well diversified upside performance prospect for their portfolios.
Well, actually, you've taken away my last question, but I'm nevertheless going to ask you, from what you say, you're not expecting this oil price and even to some extent other commodity recovery to have much legs. If oil prices indeed recovered at the pace they have done over the last week, then the Indian outperformance will not be what it was in the last 12 months.
Well, you're absolutely right about our view on oil prices and commodity prices more generally. If the Fed is merely delaying the eventual rate hikes, and again, we do believe that hikes will commence in March, then the dollar should remain fairly well supported as we look into next year, and a strong dollar tends to push down oil prices and commodity prices. Similarly, we have very recently downgraded our Chinese GDP growth expectations. We're now looking for, in fact, less than 6% growth in 2016, 5.8% to be exact. And a slowing China is also going to remain a downward factor for commodity prices as well. Now, while China slowing down is not good for any market in Asia, it is at least the case for India that being a large importer of energy and a large importer of hard commodities, that India at least comes out on the winning side when it comes to the China impact on global commodity and energy prices. And in that sense, perhaps India at least offers a bit of an opportunity to hedge one's position within the Asian region in the event that China does become more of a drag for the commodity complex.
So when you said 33,500 was your target, what's your timeline?
That was originally an end of 2015 forecast. I think at this point we're probably comfortable saying that we would push that into early 2016. Okay. But we're really quite confident that India is going to continue to produce some of the strongest GDP growth in the region, and ultimately much of that translating into much better looking, we think, bottom line earnings growth, particularly as some of the decline in input prices begins to actually percolate down to bottom line profitability and net income margin performance by Indian companies.
Michael Kurtz, thank you very much indeed for joining us on a host of issues. Certainly this conversation will assuage any doubts in people's mind, or at least reduce any doubts in people's mind about the strength that the market has. Clearly, global cues, according to Michael Kurtz, very positive for India.
All right, well, on that note, let's tell you what you'll get to see on the show this Friday morning. It's a big CNBC TV 18 exclusive. We'll get you snippets of a very special conversation that Lata had with Chanda Kochar, the MD and CEO of ICICI Bank. Not just that, Ajay Srivastava of Dimensions Consulting